In this video, I'm going to discuss the Foundation 15 problem from Chapter 6 dealing with differential analysis. And then we're told that Kane Company manufactures two products called Alpha and Beta, and they sell at $120 and $80 respectively. So here's some financial information on Alpha and Beta. Each product uses only one type of raw material that costs $6 per pound. So the direct materials that they're talking about right here is just one item. If it's $6 per pound, I'm assuming that Alpha uses 5 pounds, 30 divided by 6, and then 2 pounds for Beta, which is 12 divided by $6 each. The company has the capacity to produce annually 100,000 units of each product. Its average cost per unit for each product at this level of activity is given below. So any information that we have right here is based on 100,000 units. Okay, this is the expected production or the capacity. So keep in mind that if you're not producing at 100,000 units, then the cost per unit for fixed items, like common fixed items, traceable fixed items, then you have to first do a total amount and then divide it by the number of units, whatever they may be, that are not 100,000. So in other words, I just want to be clear here. This per unit number refers to a production level of 100,000. If it's a different production level, then the per unit amount for fixed items will be different. All right, the company considers its traceable fixed manufacturing overhead to be avoidable. So this right here, this fixed manufacturing amount, can be avoided if we do not produce that item. Okay, normally your fixed items are unavoidable, and this is what they're referring to here with the common fixed items. Those are unavoidable. So in other words, even if you get rid of the product, you're still going to incur these $15 per unit. But what they're telling us right here is that these right here, these traceable fixed manufacturing overhead costs, those are traceable and avoidable if for some reason we decide to discontinue that product line, which is nice. So it says here, company, yeah, that's what we just said, whereas it considers fixed common expenses unavoidable, that's what we mentioned, and have been allocated to products based on sales dollars. So the allocation used for the common fixed expenses, since we are looking at this, it says based on sales dollars. So if you notice, 120 versus 80 is the proportion being used to allocate the 15 versus 10. So, okay, so it's this is 15 out of 25. Whatever percentage that is the same as 120 out of 200 if you sum these up. So they're using this basis as a percentage to allocate common fixed expenses. Why that's the case, I don't know. That's just the way they did it. Okay. In the same way that we use predetermined overhead rates to estimate fixed costs, this is the way perhaps that they're doing it here. All right, so let's go to question number 1. What is the total amount of traceable fixed manufacturing overhead for each of the two products? So it's real important that we understand the total amount being very important here because of the fact that this is based on 100,000. So let me just go ahead and write that here. Total traceable fixed manufacturing costs. And I'll do it for Alpha here and for Beta. So we have on a per unit basis, they told us this. Excuse me. Let me move this over a little bit here so we can see this better. So this information was given to us, 16 and 18 respectively. So we'll put it in here as 16 and 18. Let me center this. And then based on the level of activity that budget or that estimate was based on, we got to use 100,000. Level of activity, that was based on 100,000 and 100,000 for this one as well. Okay, so total traceable fixed manufacturing overhead is just going to be the multiplication of that. And I mean, this seems straightforward, but here's the part where you got to be careful. Let me put some commas in here so it's easier to see. And then same thing over here. I should put dollar signs on this just so it's easier for us to understand that we're talking about dollars and not units. Okay, so here's why this is important. Even though we came up, or they came up with this on a per unit basis at 16 and 18, that's only valid, that fixed cost is only valid at this level of activity. That fixed cost per unit, to be more specific. That fixed cost per unit is only valid at this level of activity, 100,000. So anytime we have any other level of activity that's different than 100,000, we're going to have to get the total amount here and divide it by that number of units. Okay, so just be careful with that. That's all I'm saying here. Question number 2 is, what is the total, company's total common fixed expenses? So same thing, we're going to do this based on 100,000 units. So I'm going to copy a little bit of this information here, except I'm going to just change the numbers in the descriptions. This is 2 total common fixed expenses. So this is common fixed expense per unit, level of activity, and total common fixed expense. All right, so let me correct this real quick. This is 15, this is 10. Okay, so that gives us 1.5 million and 1 million. Okay, when we sum these up, just for the heck of it, let's go ahead and do it. Oh, actually, we need to sum it up because it's the total that they're asking for. My bad. So overall, the fixed traceable fixed manufacturing overhead cost is 3.4 million, and the total common fixed expense is 2.5 million. So it might be nice to just think about the fact, let me see if I can find these little things. Here we go. It might be nice to think that total fixed cost are going to be the summation of that, which is 5.9 million. Okay, not that that's something you need to know, but at this point it's good to understand that out of the fixed expenses that this company is dealing with, these are manufacturing costs. Okay, so even though this is called just total fixed expenses, they're I believe they are product cost. Oh no, my bad. So this will be non-product probably, and then the traceable manufacturing overhead is product. Actually, I take that back. This common fixed expense could be, some part of it could be product related and some of it may not be product related. It's not clear here how it's specified. But it's these fixed costs that are traceable, these fixed manufacturing overhead costs. So within this number here, whatever it is, in this case 2.5 million, within that number there might be some untraceable fixed manufacturer overhead costs. Okay, so we're not told, so we don't know exactly what that is. All right, and that is 1 and 2. Now let's look at number 3 here. Number 3 says, assume that Kane expects to produce and sell 80,000 alphas. Okay, so we're going to have to estimate our numbers based on 80,000 during the current year. One of Kane's sales representatives has found a new customer who is willing to buy 10,000 additional alphas for a price of $80. What is the financial advantage or disadvantage of accepting a new customer order? All right, so here's the first thing. Alpha normally sells for $120, right? And we're being offered a special price of $80 for some units, 10,000 units. The only reason we would even consider this is because we're currently working or selling at below capacity. And the only reason you would be at below capacity is because maybe you can't sell anymore. Even though we have capacity to make 100,000 units, this is the capacity we're at because of whatever reasons there are. If you could, you would be selling 100,000, you would be maxing out your capacity. So currently what this is saying is, hey, listen, we are at 80,000 units. We have 20,000 unit extra excess capacity. Why not consider selling to somebody at a discount? And the answer is, well, let's see if that's a good idea or not. So this, I'm going to call this a special offer consideration. And the nice thing about doing differential analysis, and one of the key things about doing differential analysis, is that when we do compute that differential income, okay, so we're going to concentrate on differential revenues, differential costs, and the net of those two are differential income. When we do that, we only analyze any amounts that differ. If there's an amount that does not differ in one alternative versus the other, then we simply don't consider it. And that's the whole key with differential analysis. Only include costs that are different under the two scenarios. Okay, so let me show you here what I mean by that. If we accept this special order, okay, the differential, and let's call it incremental just so we can, it really doesn't matter. I mean, I'm going to use differential. The differential revenue that arises from this is $80 per unit, right? They're offering $80 per unit times 10,000 units. So that's going to give us, oh, I'm sorry, not $8. It's $80 per unit, my bad. Okay, so that would give us a differential revenue or incremental revenue of $800,000. And that's the first thing we need to know. Okay, from this, okay, so this differential revenue, this is the positive side of it. We're also going to incur some costs from this additional thing, but we're only going to consider the differential costs, the ones that would change. If there's stuff that would not change, then we don't consider it. So some of those differential costs will be direct materials, direct labor. Those should be the first ones that come up, because if I make these, I have to incur additional direct materials and direct labor costs. If I don't make this, I do not have to. So there's a difference, okay? We're also going to have to incur variable manufacturing overhead, because if I don't make it, I don't incur it. And then the variable selling expenses, S&A we call it. Okay. So what we have here is this differential cost is going to be $30 per unit based on what they told us here. So if we're going to make alphas, we're going to have to spend $30 per unit times 10K. If we make alphas, we're going to spend $20 per unit for 10K. These are the things that would change. Variable manufacturing overhead is 7 per unit times 10K, and variable selling and administrative expenses are going to be $12 per unit times 12 right here. Okay. Now, I don't consider anything else, because whether I make these extra 10,000 units or not, I'm still going to incur these fixed manufacturing overhead costs. In other words, this 1.6 million, whether I make 80,000 units or 100,000 units, I'm still going to incur 1.6 million. So in my differential analysis, I don't consider it, because if I don't make it, it's 1.6 million. If I make these extra ones to sell them, it's 1.6 million. So there's no difference. There's no differential cost with that one. Same thing with the common fixed expenses. So what we look at in these special offer considerations is solely the contribution margin. If we have a contribution margin that's positive, then we may consider it. So this is 300,000. These are going to be negative, right? 200,000 70,000. Oh, my apologies. This should have been 10K here. I don't know how that came about. Okay, and then this is 120,000. So I'm gonna look and see if the contribution margin is positive. Minus this, minus that, minus that, and minus that. And what this is telling me is that if I take on this job, this special offer that I have, I would have a positive contribution margin of $110,000. If I were to consider all the costs involved imply that each item costs me $100. And if somebody offers me $80 per unit, I would immediately reject it and say, well, what? No way, it doesn't cover my cost. But that's not considering all the issues at hand. This is not going to be forever. This is a one-time consideration that we're saying, you know what, we have idle capacity, and if we can cover our variable costs, which are the differential costs, the things that I would incur if I take this on, then I would have left over 110 that can be used to cover fixed cost, or if we're already profitable, to add to my profitability line. So in this particular case, based on the financial analysis, I would accept this special offer consideration, all right? The special offer. And, you know, again, maybe I haven't said this, but this is just the consideration of the financial consequences, right? We are going to increase our profit by accepting this special offer. Now, there are some qualitative factors that we need to keep in mind that we may not be considering right now. So, for example, if we sell this item below what we normally sell it at to the market or customers, we have to make sure that other customers that are paying 120 do not find out about this, right? There's several things that need to be placed in terms of in that contract, and the other thing is we got to make sure that this person doesn't turn around and grab these items that we're selling them at 80 and sell it in the market for $90 or whatever the case may be, anything below 120, because then at that point they're competing and against us and making us have to potentially lower our costs because of the fact that they're doing that. So there's a lot of qualitative factors that we need to think about as well. But from a financial perspective, this is a go. We would say, yes, we can do this because that's going to increase our profitability. All right, let's look at the next question, which is 4 here. Under 4, we have assumed that Kane expects to produce and sell 90,000 betas. Okay, so now we're in the betas during the current year. One of Kane's sales representatives has found a new customer who is willing to buy 5,000 additional betas for a price of $39 per unit. Is this a good idea or not? Okay, so the first question is, I'm selling 90,000 betas and I have capacity for 100,000 betas. The only reason, again, why I'm selling 90 is because maybe I can't sell anymore, right? So if somebody comes up to me and says, I'll buy 5,000 more, this is worth considering because we have the capacity to make 5,000 more. But the question is there a positive contribution margin from this offer? So this is going to look very similar to this. So let's go ahead and copy this. I'm going to have to change a few things, so give me a minute here. So this is number 4. We're going to look at differential revenue. And I'm not going to write everything because now I think you know what we're talking about. But it's going to be $39 times 5,000. That's the differential revenue. And that gives us $195,000. Then the direct materials is going to equal $12 for the betas. That's given. $12 for beta. And we're going to use all this data right here. $12 times 5,000 units because that's differential. Direct labor is $15 times 5,000 units. Again, I'm considering that because that's differential. Variable manufacturing overhead is $5 times 5,000 units. That's 25. And then finally, variable selling times 5,000 units. And that's 40,000. So this particular special offer is one that from a financial perspective, we would not accept and say, no, thank you. We will continue just selling our 90,000 betas and be happy at that. Now, that's the financial analysis, right? There are qualitative factors and there are qualitative reasons why we might consider this. What if this is a customer that's buying currently a whole bunch of our other products and they're testing out this particular product and saying, well, we just want to test it out first. If in that trial period, we have this price of, what was it, $39, but then it would change if they later on want to really buy more, then this might be something we would consider, right? So it's not just the qualitative factors that we think about. I'm sorry, not just the quantitative factors that we think about. But at least the quantitative analysis gives us a start to see whether this is a good idea or not. All right, so let's look at number 5. Under 5, we have assume that Kane expects to produce and sell 95,000 alphas, so we have 5,000 excess capacity. One of Kane's sales representatives has found a new customer who is willing to pay or to buy 10,000 units of alpha at $80 per unit. However, pursuing this opportunity will decrease alpha sales to regular customers by 5,000. Is this a good idea or not? So, in other words, if we're at 95,000 units and we're going to have a special offer from somebody for 10,000 units, we're going to have to eat up, in this case, 5,000, or carve out 5,000 from our regular customers so that it will be 90,000 sales of regular customers and then 10,000 of the special offer. So again, why would we do that? We would do it if financially that's favorable for us. So it's not an issue of immediately thinking that this is a bad idea. If financially it makes sense for us, then we would do it. So let's look at that scenario. First thing is, special offer consideration. First, I'm going to look at the differential revenue. Okay, so there's going to be 2 things in the differential revenue that I'm going to consider. One of them is the additional sales, so additional revenue. And then there's another component, which is foregone revenue. So keep that in mind. If I accept this additional revenue for 10,000 units, that's going to be an extra amount of revenue of $80 times 10,000 units. Okay, so that's straightforward. But then keep in mind that if I accept that, I'm going to have to cannibalize 5,000 from my regular customers. So this will be a negative, okay? You know, I should have been more organized with this. I should have put these as negatives just to make sure that we understand that these are differential costs. In any case, I did put it here as a differential cost, but keep in mind, if you're doing this yourself, maybe you want to do the differential costs as negatives, and then same thing here. So since this is a reduction of revenue, I'm going to put it as negative. So this is going to be, I'm going to lose out on $120 per unit because that was the regular sales price for those units. I'm going to lose out on that for 5,000 units. So I'm going to go in here and say times 5,000 units. So in other words, the net differential revenue from this is going to be $200,000. So the next question for us is, okay, what additional variable cost am I going to incur in order to be able to get that $200,000 extra? And that's what we're going to see right here with the differential costs. Okay, so the first thing we need to think about is if we go ahead and take this job on, we're going to have direct materials, we're going to have direct labor, we're going to have variable overhead just in the same way as before, and we're going to have variable selling expenses. But here's the thing that you have to be careful with, okay? Even though I'm going to be making 10,000 units, 10,000 additional units, or let me restate that. even though this is based on 10,000 units, 5,000 already have been done. So when I do my differential analysis for the differential cost, it's not going to be for the whole 10,000 units. It's just going to be for those additional 5,000 units that I'm going to have to incur differential costs or additional costs. Okay, so let me restate that. This is for 10,000 units that we're going to sell, but 5,000 of those are already done. So I don't have to incur additional materials for those 5,000. So this is going to solely be based on 5,000 units. So notice how this is $30 per unit, 20, etc. So that's what I'm going to be using. But the key to this one is that be careful. Don't put 10,000 right here just because we're selling 10,000 for the special offer. You're only going to put the cost related to those additional ones that you would have to make in order to be able to comply with this. And the same thing goes for the other items. They're all going to be based on 5,000 units because of the fact that you're going to make those additional 5,000 units. So this is going to be $20 times 5,000. This one's going to be $7, and this is all from the data at the top of the information, 5,000. And finally, this one's going to be $12 times 5,000. So notice how under differential analysis, we don't have to necessarily consider all the cost involved, okay? It's just if we make a decision to take on a different job or to take on this special offer, it's only those additional costs from the point where we're at, the status quo, to this new offer that we consider. I know, like for example, you're going to incur materials, labor for all 10,000 units. But since though 5,000 of those were already done, from the perspective of the differential analysis, we don't care. Oops, I shouldn't have done that. Okay, so these are all going to be negatives. I should probably just put them as negatives. I should have done that from the beginning. Okay, let me do that. That way we're clear. So when I do this analysis here, this is going to be my differential income. And by the way, this might not be the best title on the previous ones. Let me restate that in a minute. So let me get this amount and see if this is worth doing or not. So when I do my analysis here, if we take on this special consideration, this would not be beneficial to us because we would be losing out on 145,000. So the response would be, do not accept that special offer and just keep selling your 95,000 for the regular price. Okay. Now this, in this particular case, ended up being the contribution margin because we did the differential revenue for a specific amount of units, and then we did all the variable costs for that same amount of units. So by definition, it's contribution margin, but this is really a way we got to look at it is more as differential income or loss. And in this case, it was a differential loss. In the first one, it was a differential income. Okay, it just happens to be that differential amount by definition is different contribution margin. So here, if I were to put contribution margin, that would be a little bit misleading because this is the revenue for a certain amount of units, and then we do the cost for a different amount of units. So we got to be careful with that. All right, let's look at the next question here, which is 6. And under 6, we're being asked, assume that Kane normally produces and sells 90,000 betas. What is the financial advantage or disadvantage of discontinuing beta? Well, this is simply a contribution margin analysis versus what fixed costs we might be able to get rid of. Okay, so let's first do this. Product, drop or keep product line. So normally the analysis is very straightforward. If you have a positive contribution margin from any product in the short term, you keep it because that positive contribution margin is helping you cover fixed costs, even if overall you're at a loss for the company. Now that's in the short term. Like if in the long term, you can't make this product fully profitable where it covers both variable and fixed, then in the long term, you might have to do something else. But in the short term, if you have a positive contribution margin, you keep this item. Now, what's a little bit different here is that I know we have a positive contribution margin, but we also have traceable fixed manufacturing overhead costs that I can get rid of, and that can change things around. So let's look at number 6 here. So the contribution margin lost, if we get rid of beta, is going to be, let me see, what's the contribution margin per unit? This one gets sold at 120. I'm sorry, no, beta gets sold at $80. And then the variable costs for this item are 12, 15, 5, and 8. So that's 27, 32, and 40. So my variable costs for this computation are $40. So in other words, each one of those products that we sell has a positive contribution margin of 40. So if we were to get rid of, how many was it that they said? Under 6. If we get rid of 90,000, then that would be a loss contribution margin of 40 times 90,000, or $360,000. So immediately by looking at that, I would say don't get rid of that product line in the short term because there's a positive contribution margin. But here's the little extra kicker on this one. It's the fact that some of these fixed costs, they're saying they're traceable and they're avoidable. That's important. They're saying they're avoidable. Normally they're not easily avoidable, but in this case they're saying that these would be avoidable. And if that's the case, then we need to incorporate that in here and say, well, that is something that can influence this decision. So in other words, when we go back to our first analysis here, number 1, where we said we calculated the total traceable fixed manufacturing overhead costs. For beta, it was $1,800,000 right here. If they are avoidable, okay, what that means is that if I get rid of this product line, I can reduce these costs. And that's not always the case, but in this case it is. Whereas this one right here, this is not avoidable. This one, if I get rid of beta, I'm still going to incur $1 million of common fixed expenses. But this one is one that is differential. So since it is differential, I'm going to go in here and say the traceable fixed manufacturing overhead cost of $1,800,000 is 1.8 million here. And let me just be a little bit more descriptive here. This one, so this is the contribution margin that's positive, that's lost, right? And this would be cost that we can get rid of. These are differential. This is, let me put commas in this. And by the way, with these types of analyses, the positive and the negative, you don't have to worry so much about what you describe as positive or negative as long as you understand it. So for example, I'm describing this contribution margin lost, okay? This is, you can think of it as the bad thing, as a positive. But if you want to think about, if you want to model it as a negative, because this is what you're gonna lose, then that's okay. As long as the opposite, the one that you can get rid of, you model as a positive, that's okay. Okay, so I'm basically saying that I guess I could model this one as a negative because this is what we're losing, right? And then I'm going to model this one as positive because this is the part that we can get rid of. This is a cost that we would be able to get rid of. That's a good thing if we get rid of the product line. So either way, it doesn't matter how you do the positives or negatives. What I understand from this is that my profit would go down. My differential income would go down by this amount, the net of those. If I were to get rid of the product line beta, my income would go down by $1,800,000 because of the fact that it has a positive contribution margin, and that's a bad thing if we lose it. But this is a good thing. We can get rid of some of those fixed costs if we get rid of it. It's just that the fixed cost that we're getting rid of is not enough, okay? So even with the fact that we can get rid of some of those fixed costs, even with that fact, we still want to keep beta in the short term, or whatever the term might be for you, okay? So let's go ahead and look at number 7. All right, under number 7, we're being asked another product line one, okay? So assume that K normally produces and sells 40,000 betas. What is the financial advantage or disadvantage of discontinuing the beta product line? Okay, so notice what they're trying to do here. They're saying at 90,000, the one we just did right now, and let me with 90K betas, okay? And now let's contrast that with 40K betas. And if you're picking up on what they're trying to do there, what they're saying is at 90,000, selling 90,000 betas, it's not a good idea to get rid of that product line. But if for some reason we're selling very few of them, then the contribution margin that we lose is small, right? It might be smaller than the 1.8 million that we can get rid of. And that's the question. That's the analysis that we're trying to do. So let me do this math quickly here. This is not 90,000. This is 40,000 times 40K units. So in other words, if we are producing and selling only 40,000 betas, their contribution margin is still positive. It's 1.6 million. So that, you know, if we were considering that alone, we would say keep it still. But we're not considering it alone. We're considering it with the fact that if I get rid of betas, I can get rid of this cost, which means that under this particular scenario, it would be beneficial to get rid of beta because of the fact that overall our profitability will go up by $200,000. And again, this is a quantitative analysis. I mean, it might be that next period we're going to sell more, and you may not be wanting to get rid of a product line just because you have a bad period, right? But from the financial perspective, this is what we are looking at. And then the qualitative perspectives, those are case specific, those are company specific. Whereas the quantitative factors, those are the same, okay? So whether you are a company A or company B, this quantitative analysis will be the same given the same information, but the qualitative factors may not be. All right, next let's look at number 8 and see what they're asking us here. Under number 8, it says, assume that Kane normally produces and sells 60,000 betas and 80,000 alphas per year. If Kane discontinues the beta product line, in other words, if we discontinue these 60, its sales representatives could increase sales of alpha by 15,000 units. What is the advantage? Is this a good idea or not? In other words, is the contribution amount that is coming out of betas an amount that is smaller than we would differentially have by selling 15,000 additional betas? And that's the comparison that we're doing, because maybe it is a good idea, you know, from the quantitative perspective. So again, this is same issue. We're considering drop or keep a product line. Let's go ahead and this one's got a couple little things. So if we get rid of beta, contribution margin lost from beta, that would be $40 times 60,000. Okay, so this would be equal to 40 times 60,000, which is that amount. So to be consistent, we're going to model this as a negative. In other words, I would lose out on $2.4 million by getting rid of beta at the current production level. So now I'm going to look at the traceable fixed overhead costs. And these are the ones that I can get rid of, right? So we know those are 1,800,000 from before. Okay. But the extra thing that happens is that now we have an additional contribution margin gain from the alphas that we're going to be selling. So I'm going to put here alpha. Because supposedly by us taking on this decision of getting rid of the betas, we can sell 15,000 additional alphas. Okay, so the contribution margin for alphas, which I haven't done yet here, contribution margin per unit is a sales price of 120 minus all the variable costs. So when we get up here, it's 120 each. Variable costs are 30, 20, that's 50, 57, and one more here, which is 12, so that's $69. Okay, so that'll be the variable cost that we consider. Okay, so minus 69 gives us 51. So each one of the alphas that we're going to now sell, the additional 15,000. So those 15,000 additional units are going to give us a positive contribution margin. So it'll be 51 times 15,000 units. And that's $765,000. So the question is, what's the differential income here? Or loss? Okay, so when we net these out, we get a positive 165. So independent of the qualitative factors, from a quantitative perspective, we would say that this would be a good idea to get rid of the 60,000 that we sell for alpha, for beta, and then sell these additional alphas, 15,000 of them. It'll increase our income overall. All right, let's go to the next question here. Number 9 is asking us, assume that Kane expects to produce and sell 80,000 alphas during the current year. A supplier has offered to manufacture and deliver 80,000 alphas to Kane for a price of $80 per unit. What is the financial advantage or disadvantage of buying them from the outside supplier? Okay, so this is a different type of decision. We're going to go in here and make a make or buy decision. Okay, so the first thing I'll do is make a couple columns here. These are my differential costs for making, and then this is my differential cost for buying the product. So if I buy this item, then I'm going to incur it's $80 per unit times 80,000. So this will be my cost of purchasing, and that's going to be right here. So it's going to be $80 times 80,000 units. Let me go ahead and put some commas in here so it looks a little bit easier on the eyes. Okay. Now, on the other hand, if I make it myself, I'm going to incur direct materials, I'm going to incur direct labor, variable manufacturing overhead, and then the traceable fixed manufacturing overhead costs. And I consider these. I'm going to consider the traceable ones because those are the ones that I would be able to get rid of, right? And I ignore selling expenses, even the variable ones, because I'm going to assume that you're still going to have to pay your employees to sell the product, so we can't get rid of that. So this would be, if we make them, that's going to be $30 on materials, that's from the original data, for those 80,000 units. The direct labor is going to be $20 per unit times the 80,000 units again. And I'll put commas in a minute here. The variable manufacturing overhead is going to be equal to $7 times 80,000. And then finally, the traceable fixed manufacturing overhead cost for alphas, if you remember, that's 1.6 million. So the whole amount is what you got to consider because that's a fixed cost. So that'll be 1,600,000. Okay, and these are the costs that I would be able to get rid of if I were to not make this, and that's why they go into the differential analysis. So here I'm just going to get the totals for both and just compare. So that's this one, and then this we know what it is. And we get the difference. We find out that in this particular case, it's cheaper for us to make it. Okay, so it's favorable for us to make the item instead of buying it up from outside. So let me put some commas in here so it's easier. Okay, and not only, when you make this kind of decision, the make or buy decision, if you make it in-house, you have control over the quality of the product you're making. Sometimes when you're buying from a supplier, that might not be the case. So in this case, those qualitative factors you don't even have to think about. Making it internally is much better for us financially. Now, if you have a supplier that maybe can make a better quality product than you can, then at that point you need to consider those qualitative factors as well. Okay, let's look at number 10. So the decision there is make this in-house. Okay, we're going to make this product in-house instead of buying it from an outside vendor. So let's look at number 10 now. 10 says assume that Kane expects to produce and sell 50,000 alphas. A supplier has offered to manufacture and deliver 50,000 alphas to us for $80 per unit. What is the financial advantage or disadvantage of buying these 50,000? All right, so now you can start seeing what's going on here. If the number of units gets small enough, it might be favorable for us to be able to buy from an outside vendor. So let's contrast this. This was for 80,000 units. And then if we come over here, we're going to do that same analysis, but for less units. And that might change things, okay? So let me call this number 10. And this is a make or buy decision for 50,000 alphas, to be specific. So we're going to do the same analysis here. We're going to compare the costs and see what's more favorable. So I'm just going to cheat a little bit and copy this over here, except that now the amounts are for 50,000. There's that one, and all of these will be 50,000 as well. And don't get bogged down with the number crunching, okay? Sometimes we get a little stressed out if we're doing all these number crunching here, but keep in mind what your goal is, okay? Your goal is to figure out whether it's financially beneficial for you to keep making it in-house at this level or buy it from an outside vendor. So based on this comparison, it seems like it's much better financially for us to buy it from an outside vendor than for us to try to split, the fixed costs and all the costs that are involved into so few units, okay? The key that's driving this is this. If you can make enough units, then you spread this cost over more units and your fixed cost per unit is going down. But whenever you make a small amount of units, then more of this 1.6 goes to each unit. And that's when the advantage goes to the outside vendor, okay? And again, the qualitative factors. If we have it made outside, is it the quality that we want? Are we controlling that? And those are the things you have to think about, okay? Are we giving any proprietary information if we have somebody else make it outside? And those are things you got to think about. Okay, 11. The question is, how many pounds of raw material are needed to make 1 unit of each of the two products? I think we answered this at the beginning, but if you remember, they told us that both alpha and beta, they only use one type of raw material, and that costs $6 per pound. So if they're estimating that alpha is going to cost us $30 in materials, then that's 5 pounds. 30 divided by $6, that's 5 pounds. So I'm going to briefly do that here. We have alpha and beta. And this is simply going to be the $30 divided by $6 per pound, and that's 5 pounds. And then this one here is going to be $12 divided by 6, which is 2 pounds. So I think I know why they're asking this. We're headed into a constraint resource environment. So whenever we have one of our factors of production that is limited, we start thinking about the contribution margin in a way different way. So for example, if you had no constraints when we did this analysis between betas and alphas, okay? Beta has a contribution margin of $40 and alpha has a contribution margin of 51. Let me actually formalize that over here. So the contribution margin per unit for alpha, we said was 120 minus 69. Those are the variable costs, okay? And then for beta, it was 80 minus 40. So that's revenue minus variable cost, and that's 40. That's what that is right there. So if you had no constraint, independent of any constraint, you could make as many as you would like. You would just simply make alphas and sell alphas because you would make the most money. But in life, you know, you have constraints, or you have some of the product that is sold for alphas might be dependent on people buying beta as well. So we have to have a combination of products. We can't just sell alphas and make all the money in the world. There's, you know, constraints. There's always constraints. So the constraint under a scenario that I just described is we might be only able to sell so many alphas to the market. And then once we're done, what do? We sit there and not do anything? No, we go to a less profitable but still profitable product and try to max that one out as well. Okay? So 12, I believe, goes into this idea of the constraint resource. It says, what is the contribution margin per pound of raw material? There we go. So that's what we were headed to. So 12 is asking for the contribution margin, not per unit, but per pound of material. We know what the contribution margin per unit is. That's 51. But the contribution margin per pound of material, in other words, for every pound I use, and I know this is hard to visualize, okay, but for every pound of material I use, we're getting 10.2 of a contribution margin. And then same thing over here, for every pound I use of material, with beta, I'm getting $20 of contribution margin. So if in a particular period, let's say, you were limited in terms of the pounds of raw material, then you would consider the contribution margin not per unit, but per that constraint resource. And I would say, you know what? Just for this time being, when we have this limitation of materials, I'm going to sell betas instead. I'm going to max out betas. And then once I max out betas and I can't sell anymore, then I go to alpha, because within this constraint, beta is giving me more return for my investment. So then question 13 addresses a little bit of that. It says, assume that Kane's customers would buy a maximum of 80,000 units of alpha and 60,000 units of beta. So that's the maximum that the market is willing to accept of this product. Also assume that the raw material available for production is limited to 160,000 pounds. And that's the key right there, okay? So if we have no limits on other things, we are limited to 160,000 pounds of material. The question is, how are we going to use that material? And my response is, let's max out betas. Because for every pound I use of material, I'm getting $20 of contribution margin for the betas. Whereas for alphas, that's less. And then once I max out on the betas, then I go and sell some of the alphas. Okay, so here's the way we would do the analysis. I'm going to max out on betas, right? So what's the units, the number of units? The number of units that I can sell of betas, the max, they told us, is 60,000 units. So I'm going to go in there and produce and sell my 60,000 units, and the amount of material, pounds of material used, will be, let me go ahead and multiply that right here. So if I'm making 60,000 units, and I know that each unit takes 2 pounds, oh, I'm sorry, it's right here, my bad. If I know that each unit of beta takes 2 pounds, then I'm going to go in here and say, okay, once I do these 60,000 units, I will have used 120,000 of the 160,000 pounds that I have. Oops, that's not what I wanted. That's what I wanted. So the way we got to figure this out is, I know that my max right here is 160,000 pounds. I can't get any more material. Okay, so the next question is, how many of alphas am I going to make? And it's all dependent on how much material you have. And in this case, you're only going to be able to have 40,000 more pounds of material. Okay, so we maxed out on betas. We can't sell anymore. Now we got to sell whatever amount corresponds to 40,000 what are those alphas, okay? So in this case, since each one of these units of alphas used 5 pounds, that's given right here, then I would be able to make this amount. 40,000 pounds divided by 5 pounds each is 8,000 pounds. And I know it doesn't seem initially clear why we do this, but because of the fact that if we had no constraints on the material, we would just make alphas, okay? Max out alphas and then make betas. But this is a different scenario. Here we are now limited in terms of the material, and since beta uses so little material relative to alpha, on a per pound basis, beta is the one to make during a constraint scenario of materials. Okay? All right, so now number 14 says, if Kane does follow with our recommendation here of making these number of units, what is the total contribution margin? Okay, so contribution margin per suggestions on 13. So you gave this advice. So for alpha and for beta, I guess I could just do it here, sorry. Okay, so my the number of units, let's go ahead and start that, it doesn't matter. We said we were going to make 60,000 of these and 8,000 of these to max out the number of, or the pounds that we have, and max out our profitability there. The contribution margin per unit, which we did before, is 51. Oops. That's from this here, 51, and then 40 over here. It's on a per unit basis. So my total contribution margin is going to be the multiplication of that. If we follow this suggestion, this is the total contribution margin that the company will have. Let me clean this up a little bit. Okay, and then let me sum it up here. Now, this is an ideal thing during the period where the constraint exists. Once the constraint passes, then we're no longer going to continue doing this, okay? By the way, I just noticed that I put these backwards. 60,000 is the beta. So this is 60,000. We're going to make 60,000 of beta and 8,000 of alphas. My apologies, okay? So that's a very different contribution margin, okay? So if we do the 60,000, excuse me, I'm moving this table here. If we do the 60,000 of betas during the period of constraint, then that gives us 2.4 million contribution margin, and then 8,000 of alphas, because that's the rest that we can use, and that's that. So our contribution margin during that period is 2.8 million. Now, like I said earlier, once that constraint is done, let's go back to our old methods where we're maxing out on alphas instead of betas. Okay, and then finally, number 15 is asking us if Kane uses 160 pounds, 160,000 pounds of raw material as you recommend in requirement 8, up to how much, up to how much should it be willing to pay per pound for additional raw material? Okay, so currently we use the current cost for material. So current cost per pound is $6. So that was just given from above. Okay, and since I'm maxing out on this one, then the analysis that I need to do really is based on the amount related to alpha, because that's the one that I'm going to try to that's the one I have now a limitation on. Or in other words, another way to look at it is, you're going to add on the contribution margin of the lowest one. So in this case, I'm going to add on the contribution margin per pound for the alpha. And that's the 1020. In other words, I would have to lose out 1020 per pound for me to say I can't pay anymore. So up to this summation, okay, and let me go ahead and do that. Up to 1620, that's the maximum amount. That's the maximum amount I will pay per pound in order to still be profitable with the alphas. Because keep in mind, I'm making alpha as the last one, the one that is going to be made with the remaining materials. So at this point, I would say, okay, even though I could pay currently $6 per pound, I'm still profitable in terms of contribution margin by $10.20 per pound. So I can put up with an increase of $10.20 to break even, let's say, per pound. And that we would say is $16.20. So this didn't give us the 20 cents. There we go. So that's the maximum amount I would pay for the materials, for raw material per pound. Okay, this concludes the video for differential analysis.